here we are, MMTs. We're dealing with price controls in a 660 put that we had a limit orders at 220 now. Once we got above there and made that 77 highs, I had these bids out a long time ago, and I'm going to have the 665 put to buy live right now. I have it at 490 to buy. They closed at 830. Now, because this side of the market in the very, very macro short term is deflated, they wait to take time premiums out. Like 3-4 minutes ago, they dropped these $1, but they were keeping them between 440 and 470. Now we're down here. Now my lower price level was 220. And why is it that you need to learn that, yes, I've taken this down into the mid fours? And why is that? Because they don't take as much premium out in the current bid and ask on a what we call high options trading frequency, which means that this is program script to the actual equity, which it is. However, they have a way of stealing the price premiums using robot computer software generated programs that are tied to the equity now. And that the lower market remains below there because during this supply and demand of the bid and ask, just as it was $1 between 440 and 460, well, if you would have bought them, look at all the people that bought these contracts up at the highs. But now we have a 210 penny ratio spread. And this is what we're looking for when making money in this pit. And the only way that money is made in the pit is that the higher the range, the more downside deflated, and this is all based on intraday only. Okay? And anybody watching the video here is that chart on Google, and you can see that Google breakout here live. And right now, I'm telling you, we're 2 minutes into this live trade, and we're going to, boom, look at that. We're at 97 IR. We've got nothing but diamonds popping to that high side. We're going to start hitting that 9 bar. And we're at 98. And Ron, when this goes higher in value, called TR ratio in your operator platform, market maker platform, when this goes higher and keeps going higher, that means that the stock is making a series of higher highs. And how do you validate it? Well, we just got 101 highs here. That validates that high of 0.37. That's called higher highs. And so now we're finally getting a red bar and a 9 bar on that opening bell. And the options make a 340 low, so what? We have to see what portion of the script, in the electronic script here, he hits at 665. He took it right to this strike price right here. I had 550 bids. We lowered them. But then we had a couple of takes in there. But once again, it's its first 3-minute pullback and a 9-minute breakout here. And this is the premium, 660 put live. How long have we been open? 19 minutes in the marketplace. What is the market? Everything has been having a sell gap. We were up bigger in the Dow and pre-market futures due to the retail sector. Now, Google's finally kicking on all cylinders. And we said a couple of years ago it would take to get that build out done. Well, if they keep going on the course that they're going, I'm telling you, Google could run and be a leader of 2013, as we always said, depending on where we're at economically and their execution, rolling out their new platforms. This stock could go to 750 easily. And we said that back in 2010, 11, and 12. But it would have to be at a certain point in time when you went through 36 months of development, and then you start to deploy it. 20-minute bell. We have a diamond pullback. Sorry about that. We had a diamond pullback to here on the 9 bar. Here we're at 350 by 370. Here we're 580 by 6. The spread on the 665 is 2.9. 290 pennies here and 210 pennies there. What do we do best? Well, as you can see here, we know what we're doing about buying wholesale. Before the market even opens up, we already know the prices, where they're going to go, and what the mechanics of it is. And when does a stock show the reversals like they are? But look at how strong that first 3-minute pullback is to that other diamond. It kind of undercuts it, but it's above it. Look at that. And it's working, and I'll populate the rest of them. So these ratios, the greater these ratios, the more deflated this gets short term. Range is minus 290 down here from the close. There's the high. They gave it a 10-cent premium, big deal. And they walked them right to my price target of 550, right to the target. And here, the lower target is $2.20. The reason why that is because then they would be super deflated, and the amount of dollar capital risk. So we take the dollar. We got a reversal though. So we got to watch that 6 bar. That's a 9. There's the 12. 3, 6, 9, 12. All right here. And look at the put option. Here's a 660. With the $2.10 range, but they got a 30-cent premium off the bottom already. 840, 850. There's the spread. 2.9. And it's a 550 with the 50-cent spread on the first pack on 12 minutes of the opening bell. So when you're learning how to get this wholesale entry, you also have to know how to limit the order out. And what would you do? You go to your InstaQuote and throw the order out at 610. You throw it out at 610, and someone's got to buy it from you. So based on that support level, you know, people get executed. So 2 of them out at 610, and that's a profit. Does it matter that they're 6 by 620? No. You had to get someone to pay the 610. And there's the print, 610 there and 610 there. And that's live. And getting hit at 550 and selling at 610, when you have 10 contracts and you learn how to do this, it's a pretty good day starting opening bell wage. It's about $600. Okay? But you have to know how to exit these things based on what this is, because there's a mathematical high-frequency option code relative to the relative peg to this price movement in both directional up and or down. Right now, we're working with the upside of that big, nice rally from yesterday's big rally to a continuation diminishing. We got 4 handles out of it, for crying out loud, in the short term. And today's date, my friends, is 8/14/2012, dog days of August at 6:53 a.m. Pacific Standard Time, and it's all about understanding option premium. And new MMT market makers in this, that's what you are. And the thing about it is you're always constantly buying the markdown below the wholesale bid and then selling those spreads back because someone's got to pay it. That's why you sold them at 610 right here where my pointer is. 610 out, 610 out. You don't sell, then the bids are $5.90, and then you have to try to get $6, which is fine. But the thing about it is there are variances or different transactions that take place with market makers. You always take the first round of profit. Then when the thing pulls back, we buy more. So this is how you trade 10 contracts on the opening bell at the low of the day and selling right in there. And you take your money. Period. Whether they want to go higher or not, that's irrelevant. What's relevant is that you buy again on the pullback so you can sell at 690 on the way out. And that's the next transaction that we would do. Yeah, we don't get hit on the low of the day. I called that number before the opening bell. But yeah, if we could get in, and depending on what the support level does, we may have to pay 610 and sell at 690 on 10 contracts with a profit objective of $700 to $900. Once again, it's been a privilege for you to be able to go back and review this opening bell. Thereafter, you're going to be able to answer me some questions. You were present. You're watching the level 2 bid and ask. And this will be helpful for you when you go in your live transactions.